Hello traders, this is Easy, and today I'm going to talk about the 6 most important reasons why 90% of the traders blows their accounts within the first 90 days. Okay, so today I will be discussing all the reasons which I have experienced personally, and I will be going very deep into it. So before being a profitable trader, before thinking about making any profits, you must know what you should avoid doing. Okay. So before knowing what you should do, you must know what you shouldn't do. Okay. So all this presentation will be based on that topic, that what you should not be doing. All right. So let's start. The first most important reason why most of the traders lose their account is trading against the trend. Guys, most of the beginner traders and even the experienced ones try to pick tops and bottom. They want to look very fancy. They want to like beat the $7 trillion market with their senses, right? So this is the most important reason why people fail to grow their account. 80% of the trades are lost in an attempt to pick tops and bottoms. Okay, avoid it even if it seems tempting to you. Okay, so when the chart is moving, uh, an urge comes out of our heart and we get tempted out. Okay, and in that temptation we go into the trade and we do wrong. We play against the trend and ultimately we get stopped out. Okay, so you should always trade along with the 20 period simple moving average. I hope you all have used 20 period simple moving average in any period of your trading, right? So I don't find any other baseline or any other trend indicator that is more superior than 20 period simple moving average. It is a very superior tool. Okay, how to use it, I will be making a next video onto it itself. Okay, so I use it on every day on every period of charts, so this is that important. To be very brief, what I would like to say for now is always trade with 20 period simple moving average. That means when the 20 period simple moving average is inclined, you are a buyer. When a 20 period simple moving average is declined, you are a seller. That's it. Okay, so we'll be discussing in details in next video. Let's move to the next main reason why people lose their account. So the second and most important cause why people lose their account is they try to do Martingale. If you do not know about Martingale, you are one of the lucky traders, I'll say, because this strategy, I have almost thousands of dollars using this strategy. And once you start using this strategy, it gets incorporated into your blood, into your mind. You can't get it out very easily. It becomes very difficult. Whenever you are trading, that martingale trader gets into your head and it mm, um, stimulates urge into you to place more trades. For those who do not know about Martingale, let me be very brief about Martingale. Martingale is a kind of trading strategy that people uses when they are losing. Means you have a place to trade, and if you are losing in that trade, then you will place again a trade. Okay, if that also goes into loss, you are going to place again a trade in a temptation to gain all at once. You are facing loss, so you want to get more out of it. Okay, and you keep on placing trades. Sometimes it works out and sometimes it doesn't. Okay, and the period when it works out can be the worst thing that can ever happen to a trader. I'm saying this because once you win using Martingale, you get addicted to it. And once you get addicted to it, you're gonna try it for all the losing trades. And if you try it for all the losing trades, then ultimately you blow your accounts doing Martingale. Okay, so this is from my personal experience, and even all the traders will agree with me on this. Okay, so this happens basically of greed, that you want some more. Okay, or you don't want to lose what you are already losing, so that can be another reason. Okay, this is not a successful strategy and this may blow your account very quickly. All right, so what I suggest is do anti-martingale instead. What does that mean? If martingale is bad for your account, then anti-martingale might work well for your account, right? So what is anti-martingale? Like in martingale, we add to our losing trades in a similar way. In anti-martingale, we add to our winners. Okay, let's say you are winning in some trade, and if you get a appropriate position to add to that trade, you must add to that trade. You must add to your winners, right? You should never add to your losers. Losers add to their losers. Okay, winners add to their winners. It is that simple. Okay, so if you don't know about martingale, never go into it. If you know and if you have used it, quit it immediately. All right, so let's move to the next, the most important cause for blowing up your account, and that is reaction to loss is worse than loss itself. Traders, loss is part of everyone's trading, right? There is no trader in this world who do not lose, right? But how you react to it is far important than loss itself. Okay, if you react very badly after losing, then that reaction can lead you to more losses. Okay, so you might be relating to my words, right? Because this is what every trader face. So you should be mature enough to not react in a way that hampers your trade further. All right. So revenge trading is one of the most important reason why we lose more after losing couple of trades. When we are seeing our account after a loss, we are not satisfied to see that number. Let's say you have $1,000 account, you placed some trade, you lost it, now you are at $900. You don't want to see it there because you put $1,000 into your account to make it 1,100, 1,200, right? But it went down to $900. Now you don't want to see it over there. So what you do revenge trading. Okay, and revenge trading ultimately leads to not following a strategy anymore. Okay, And the main reason behind that is whenever you are following a strategy and you place trades with your strategy, right, but you get stopped out because of other reasons, okay, and ultimately you will get stopped out even if you have quite good strategy, right? So what kind comes in our mind is that I followed all this strategy, it I got stopped out. So now I'm not going to follow this sit strategy, and I'm going to recover my account anyway. This is called revenge trading, okay, which is very harmful to your account. Okay, so never fall into revenge trading. You also start doing random trades, okay. If you can't handle the loss, what you do, you start putting on random trades. That means without proper strategy, without stop loss, without trade take profit, okay, you keep on placing trades, and this has happened to me several times in my career, okay. You just are fed up with where you are, and you just want to do something very nonsense and gain your account back, and it will ultimately blow your account in all right. So another thing that I would like to mention here is emotional trading. You trade based on your emotions. You start watching trade tick by tick, okay. You want to see every peep moves ups and down, right? And when you watch tick by tick, your emotions come out in every tick. Let's say it's going in profit. Two types of emotions can come into your way. One is greed, that you want more. Another can appear is fear, because you don't want to lose what you have already gained, right? If you are going to loss, then also two kinds of emotions may trigger you. That is, first one is greed. You are into a loss, but you don't want that stop loss to get hit, okay. So you'll pull that stop loss away, or you'll just remove it, okay. So that is a greed. Another thing is fear, okay. Now you are fearful that trend is not going in my way, so if even it comes to a break even, or even it shows me a blue color, then I'll remove it. That is a fear. So same happens, trade sometimes comes to a break even, it shows some blue, some cents or some dollars, let's say, and you just snatch it because you already have seen lots of losses during that trades, okay. So do not watch your trades. You place your trade, put your stop loss, put your take profit, and just move on. You watch something else, okay. You can listen to music, or you can look for other trades in other pairs or the other charts, right? You just don't keep on staring at your trade, all right. So I hope you have got the point. Okay, so now let's move to the fourth reason why people blow their account. Well, this reason might surprise many people, but it's true. Lack of capital is another most important reason why people lose their fund. Okay, so lack of capital won't allow you to perform your strategy, okay, in many ways. All right. If you have a lack of capital and if you don't want to lose that, then you act as an timid in a market. You just can't see, if let's say if you have $500 account, and when trade goes into $10 loss, your heartbeat starts beating in a fast way, right? You are just afraid that I'll lose $20 or $30, I don't know, right? So Forex is a game of transferring money from timid to brave. Alright? So lack of capitals entitles you to be timid most of the time. I don't say all the time, but most of the time, and it happens to most of the traders. Okay? So next point is you can't go to a gunfight with a bare knife. They will just cross you. Yes. So this is a $7 trillion markets, right? And you can't go with your till $200 and $500 and you just rob the market and you can come back with your pants on, with your shorts on. Oh, it is quite near to impossible, right? They will rob you. Who are they? They are big banks. This is not suitable for swing trading. Now, well, if you do swing trading, if you hold your trade for multiple days, if you hold your trade for hundreds of pips, then a small account won't be an ideal to do swing trading. It will prevent you from doing swing trading. And what you do, you find a solution of trading into 5-minute chart, 10-minute chart, or even 1-minute chart, right? Which is very dangerous for new traders again. So lack of capitals will lead you to trade into a small time frame, and when you trade to the small time frames, you'll place multiple trades, you will pay lots of commissions, and you will lose ultimately. So lack of capital is another important reason that I found responsible for beginners trader for kicking out of the market. The fifth point is bad money management, and it is one of the most important point I must mention. So what is bad money management? At instant and to be very brief, bad money management is a kind of money management where you do not know how much you are going to lose. You do not know about your lot sizes. You don't know what lot sizes you must place. What is your risk per trade? These kind of things. Okay. So trading higher lots than regular in search of quick profits can be one of the main reasons for bad money management. Whenever you lose a trade, you are not satisfied with the account size you are trading right now, what you will do? You will place extra lots. Let's say you are trading with 0.02 lots. Okay. Something happens to your mind. You just want to have more profit at once and you just place trade randomly like 0.20. Okay. If you place like that to get more profits very quickly, you place the trade and you experience what you feel. As soon as it goes into loss, even few pips, your heart starts beating very quickly. Well, your emotions will attack you because you were supposed to play 0.02 lots, which would ultimately lose anywhere around $5, let's say, according to your stop loss. But now you have placed 0.20 lots. Now you are going to lose maybe $50 for the same stop loss. Oh, you are not ready for that, right? When you see $20 or $30 floating and your regular stop loss hits $4 to $5, let's say, you will forget all the rules, okay, and you'll end up making no money from that. because once you see the loss, you will just pray to be break even and you will not do this mistake again. That's only you will pray for, right? If you have faced it, you can relate it to. All right, and I hope all the traders face it. Okay, so avoid trading higher lots in any kind of situation. Okay, even the setup is quite good, you trade with your regular lot sizes. What could be the regular lot sizes? If you have $1,000 account, you will place 0.10 lots at maximum. All right, if you have $100 account, you will not place trades more than 0.01. All right, and once you place your trades, there must be a stop loss. All right, so you don't lose more than 1 to 2% per trade. Okay, another thing that I would like to mention in bad money management section is place trades without proper risk assessment. I have already explained about stop loss and take profits. So you first analyze, you do assessment to your trade where you are placing. Okay, you identify what is your risk, what is your reward, what is your lot size, and then only place a trade. Okay, so risking too much on a trade leads to a lots of bad decisions afterward. As I already mentioned, you will ultimately make lots of bad decisions once you start making bad decisions. Okay, so first bad decision leads to several other bad decisions. Okay, so avoid it in the first place. Okay, bad trading psychology is the sixth and last most important point why people blow their account. You have got a very profitable strategy, let's say, but if your trading psychology is not in place, you will ultimately lose money. But if you have a good trading psychology, but if you do not have a very good trading strategy, ultimately you will make money. It is that important. Yeah, I have experienced it and many of you have experienced it too. Okay, so why bad trading psychology affects our trades and how it affects? Some of the reasons can be due to past bad experience. Okay, so due to past bad experience can be one of the main reason why you face bad trading psychology, right? So when you have so bad trading experience might lead to bad trading psychology. So you must avoid all the bad thinking, bad experience you have experienced in the past regarding trading, and you just be present into your charts. Okay, another thing is current account size. You are not satisfied with the account size which is with you right now. That also impacts your psychology in a very bad way. Another important point is money driven rather than process driven, and believe me, this is most important thing. of, of course we all are into trading to make money, okay, but if you want to really make money from trading, you must not focus on the money itself, rather you should focus on the process. And if you follow the right process, you will ultimately make money. But if you focus on money If you keep on staring at your P&L all the time, there is greater chances that it will impact your trading psychology, leading you to making no money at all. Okay, so what are the solutions? The first solution is avoid viewing P&L. Whenever you are trading, do not look at your P&L. Okay, you have already set your stop loss and TP, so do not worry. All right, just place your trade and relax. Let your system do what it is supposed to do. Okay, take limited numbers of trades in a day. This can enhance your trading psychology too. Make a fixed number of trades like 5 trades or 2 trades or 3 trades per day and stick to a plan. If you do not have a limited number of trading plans, then you might end up placing hundreds of trades in a day, leading to overtrading, and that will ultimately ruin your account in all right. So next important point is process makes money. Be able to do what you know. Most of the time this is a problem with traders. They know several things. They do have a great strategy. They know what should we do into market, but when they are into the real market, they are not able to do what they know. Instead, they do what they do not know, and they end up doing some stupid things, and later on they realize that we are not as for a strategy, right? So process makes money, you do not make money. All right, so follow your process. Last important point is avoiding all kinds of FOMOs. What is FOMO? It's fear of missing out. All right, so FOMO can appear when you are entering a trade, or it might trigger when you are exiting the trade. It can attack you in both ways. Okay, so never let FOMO attack you. All right, instead you be relaxed. If some trade is missed, it's missed. Just forget it. Do not jump into a trade because you missed it by few pips. You have missed it by few pips. You just leave it. Look for another opportunity. Wait for another opportunity. Okay, if you are into a trade, you are whether the trade is going to hit TP or a stop loss, right? In that case also your FOMO might attack you. Okay, leading you to exit early, or cut your trade before a stop loss hits, or remove your stop loss, or other bad decisions may attack you due to FOMO. Okay, so never let it enter your trade.